right, let's see if this is working or not. Would be cool to see it just working with no problems. I could hear my volume as a volume check. Volume check 1 2 3 1 2 3. All right, that's fine. This will be a live stream, not a long one. Sunday, March 15, 2026. This is a update on a few different things. Starting off very quickly, you can see here the SPY, the QQQ. We'll get into the IWM and the DIA, the four major U.S. stock market indices. This is showing the close-anchored volatility bands, trying to understand where is prices close compared to possible deviation bands. And some people would use a VWAP, volume weighted average pricing, and they are attempting to use that on an intraday most often and trade price relative to that VWAP. Here, the close-anchored volatility bands are attempting to take that from an intraday perspective and view it on a broader daily time frame, and understand that based on the 10-day time frame, if we were to have a one deviation move to the downside, you would see 654. A one deviation move based on the sigma value of the 10 days worth of trading time frame. We can look from a 1, 2 to a 3 negative deviation, as well as a 1, 2, 3 positive deviation. 6 sigma deviation bands essentially is how you could view it in intraday price action wise. And this is simply just trying to understand where might price find support or resistance given a push to varying sigma levels based on the varying time frames. This data can continue from just the volatility bands into then a z-score deviation table. How far is price from its average closing price across the different time frames? We then get differing standard deviation values and have a z-score. And the z-score is telling us that we have a mild negative deviation to the downside. So there is some sell pressure over the last few trading days. We'll come back to Bitcoin. But here on the SPY, you can see that year to date, or really 6 months, this is the first trading day of the year. Let's see, right here, the market is down 3.25%, 3.5%. The range of this year so far, from the high of the year to the low of Friday, March 13th, is about 5.25%. So the S&P 500 has been selling. Some people like to view the 100 simple moving average. You could take a simple moving average, tune it to 100, and understand that now you're trading beneath the 100 simple moving average. If we tune it to 200, probably need more time. Zoom out more. You can see on the 200-day moving average, in the past, when you've broken it, it's something that you often backtest. The 200 simple moving average is a institutional moving average, and we are holding above it in the daily long-term trend still. but we are very close to testing it. So if we were moving to the downside, and I'm trying to do my best to keep the stream focused on a specific, like for short form content in this area. So when it comes to these SPY close anchored volatility bands, if we were to have a move to the downside of -1 sigma deviation move to the downside, this would be a slight test below the 200 simple moving average on the daily chart. This would be a concern in the short term. In the past, when you've broken it, you've had a continued move lower, but before you really moved lower beneath the 200 simple moving average, there was a back test. So the financial markets can have very impulsive moves and break in one direction or the other. However, it's very likely that you see a back test of these institutional moving averages. It's something that not just a retail trader is using, but someone working at JP Morgan. They are using the more tabulated data than the chart of a 200 simple moving average. But the 200 simple moving average sets the larger term trend. The larger term trend, viewing the SPY Z-score deviation table, when we look at the 10-day, that's the short-term time frame. It's not as useful as the 252 trading days, 1 year's worth of data. That's showing that we are still within the normal range. We're still just above the 200 simple moving average. We're still within the uptrend. However, on the short-term and intermediate terms, this is where you're seeing mild to negative to strong negative deviations. The Z-score is negative. And this is where you're seeing the sell pressure. We are down 3% year to date, but off of the yearly highs, we're down 5%. This is a decline in the short term, intermediate swing term. This is now, some people use the term overbought, oversold. I prefer to think in terms of expansion and consolidation that result from exhaustion. When one side of the trade, buyers or sellers, is exhausted, the other side of the trade gets expansion. When neither side is willing to capitulate and you're consolidating and you're range bound, it's not until one side capitulates, the other side breaks that range bound. But essentially, the SPY Z-score deviation table, the point of this is just to get an understanding of, across the varying time frames, is price within its normal deviation range? How far is price from its average, today's price, relative to its average 10-day, average 30-day, average yearly price? And based on our average yearly price, we're still within our normal range. Average close of 635 over the last 252 trading days. And if you're interested, let me know in the comment section down below if you would like further breakdowns to cover the NASDAQ QQQ, the Russell 2000 IWM, and their respective close anchored volatility bands. It's just attempting to do the same thing of understanding where is price in the current market relative to its 1 year ago, 60 trading days ago, 30 trading days ago. And across all the major US stock market ETFs, we're seeing in the short to the intermediate time frames, we're seeing negative deviations. We're seeing price having come down relative to where it was previously. So our 10 days average close on the NASDAQ, 604. I actually have to change that. I just noticed that. That says SPY, and that needs to say QQQ. I guess we all make mistakes, folks. Same here, this should be IWM. But I just simply wanted to get this recording and talk about this because some people are concerned that there is real threats to the U.S. financial system or that the U.S. economy will collapse. There's lots of narratives of the AI bubble bursting, and that's a whole other video to talk about. Based on the real data, when you're looking at the 4 major U.S. stock market indices, even DIA, the dinosaur Dow, it's showing that its composite has a mild negative deviation. And I didn't really explain the composite so far. The composite z-score is attempting to take a weighted distribution of each of these time frames, giving less weight to the longer time frame, more weight to the shorter time frame. And that's the same across all of the indice ETFs that are analyzed here. So we're seeing so far in 2026, as we're ending Q1, approaching Q2 2026, what we're seeing is broad market short-term declines. It has not threatened the immediate trend that the market is in from a long-term perspective of we're in a long-term bull trend. It is an uptrend of higher high, higher low structure. This is true. So the weekly chart, we're still in an uptrend, but that's pretty ugly. I'm not going to lie to you folks. This wick here is a little concerning when you understand price action interpretation. You opened the week, the buyers took it higher to start the week, the sellers rejected that price action and pushed it lower. This could be the seller's last attempt and the buyers are stepping in, and the buyers end the month of March, and we could see, this is hypothetical, this is not me telling you what will happen, this is not financial advice, but hypothetically speaking, you would, if you are a buyer or a bull in this market, you would ideally see something along this where you're closing the week, you would maybe have a slight gap up, hold the gap, and then end the week above or trying at least in this area here. You would want to be above this weekly candle's close, above the weekly candle's open. If you can close above last week's highs, that would be a massive sign that the buyers are stepping into this market, that the buyers are in control of the market in the short term, that this decline, this broad market decline that we've seen, where across all of the US stock market indice ETFs, all of them are showing on the short term negative deviations on the z-score table because of the sell pressure that has been experienced this year thus far. So the buyers would ideally get a candle such as this where they're able to retest the highs, but it's not a guarantee. It's a scenario. There's multiple scenarios. This candlestick showed us that the buyers were taking it higher into the start of the week, the sellers pushed it lower into the close of the week. This could be a sign that sellers are in control, and every time the buyers attempt to retest last week's highs, the buyers continue to step in and continue to step in only to be rejected, and we see lower highs. That is a possibility. The only thing that we can really do is wait and see. It's really easy to attempt to predict what price will do and have narratives that you can portray, but I believe the most logical approach is to understand the different scenarios that may occur and to be prepared. Hedge however the market decides to position itself. This month of March has been volatile, and you're seeing long top wicks one week after the other. Whether or not we see continued sell pressure or buy pressure to start the week, that may lay early signs for how the week closes. This massive top wick is showing that sellers were willing to overcome and push the buyers back down to start the week, and to end the week, I should say. We ended the week with sellers in control. How we start this week, if sellers are fumbling it immediately, buyers may attempt to push it higher early in the week. So from the 6th of March here, that Friday, from the close to the open, you had a gap down of less than 1%. You tested down almost 1.5% before you ended the day up almost 1%. Very volatile first trading day of the week. The next trading day, Tuesday, had the long top wick, and it was unable to have expansion closing above the prior left of price action area. Following day, Wednesday, a consolidation day, trying to test higher, holding lower highs, making slight lower lows. Those lower lows here signaling sell pressure continued. You had the gap down from, you did have buyers stepping up off the lows into the close of Wednesday and Tuesday here. However, overnight, the sellers were in control. The sellers did not allow the buyers to fill this gap to the upside. Continued sell volume. You had a gap up overnight, tested above yesterday or above Thursday's highs. Friday closed into the lows. We're seeing now the S&P 500 ETF SPY attempt to break upside now. Relative to where we closed, it is trying to break higher. It really only matters where we open. The pre-market volatility can signal us opening higher and then completely reverse and open lower. Anything is possible with how the electronic computer network ECN period, the pre-market period, anything can happen during it. They don't have to open us near the lows. They could try and bounce it towards the highs of yesterday or open it near Friday's lows. Anything is possible, multiple scenarios. They could open it right where they closed it Friday. Those are the three main options, I would say. Opening within Friday's range, outside of Friday's range, above the midpoint of Friday or below Friday's intraday midpoint. So the SPY so far, year to date, the NASDAQ is essentially down 4.25%. DIA from the open of the year to the close is down 3.2%. IWM is down less than half of a percent. It was down at the most 1.3%. It was up nicely to start this year. Let me see something real quick. I'm just curious. From there to there, the high, it was up almost 10% year to date. Wow. That's interesting. So IWM, the small caps Russell 2000, it is holding up the best year to date. So IWM has a negative 1.49 deviation. It has the largest deviation of all of them, the most negative being the SPY. So IWM, it makes sense. You know, year to date, it is the least in the red, less than 0.5% red on the year. I am not looking at chat to see if anyone has questions in right now. But the main point of this stream was just to update on this. I think this will also be made into a Substack note posted on Substack, Beta Heuristics, Substack.com here. I will most likely have a new market look ahead for the upcoming Monday and the Substack note covering the basically breakdown of the Z-score deviation tables across the 4 major U.S. stock market ETFs. Just to highlight that in the short term, intermediate term, we are experiencing the sell pressure. This is not the time to be Chicken Little, the sky is falling, and screaming that financial markets are collapsing. That is not the case. Financial markets are experiencing some well-deserved sell pressure. In the face of heightened tensions in the Middle East, the Strait of Hormuz being shut down, it has immediate consequences on the supply and the demand of oil remaining the same, the less supply or supply being constricted because the rate of at which it can flow, production from Gulf states declining or altogether stopping. The petrodollar is still robust, but oil prices continuing to climb will have adverse effects on nearly all products. All products purchased by consumers are transported via petroleum, gasoline, diesel. So when the price of that goes up, things denominated in petrodollars have to adjust accordingly. So in the long term, we're still in the uptrend. The deviation tables are signaling this. On the SPY, our yearly interpretation is we're still within our normal range. You're still within normal range on the yearly deviation score. NASDAQ deviation score is essentially the same, 0.52 versus 0.53. You're still within normal range. The IWM, the largest yearly Z-score with 0.68 within normal range, and then DIA, the Dow, with the lowest Z-score for the yearly time frame. It's still within normal range across all 4 major U.S. stock market indices ETFs, within normal range on the yearly. It's the short-term, intermediate term that's been experiencing this volatility. Well-deserved volatility. The Dow, when politicians start talking about the Dow being over 50,000, that is more so a sell signal than anything else. When the politicians start talking about how well financial markets are doing, when the masses are greedy, be fearful. When the masses are fearful, be greedy. The masses are not yet fearful. They have not exactly realized the volatility increasing. They may see that gas prices are higher. They may see that their portfolio is a little bit in the red over the last month or so. But this is very, very controlled selling to start the year. And it makes sense when you consider geopolitical tensions, when you consider the Strait of Hormuz being shut down. The United States is lifting sanctions on Russian oil exports. That is how serious the situation in the Middle East is. When you decide you are going to have regime change in a country that is much larger with a very different topological geography in Iran compared to Iraq or Afghanistan, it's night and day. It's not the same textbook play that you can run. And Trump has allegedly been complaining to his generals, wondering why the conflict in Iran is taking so long. Because the same playbook can't be run. You can't claim weapons of mass destruction go bomb the country to death and then be confused when that country starts to retaliate and hits some of the Gulf member states, Qatar, Kuwait, the UAE. It doesn't matter. Bahrain, excuse me. I mean, these Gulf states allow the United States to build military infrastructure and have bases there for the sole purpose of protecting them. And then when their oil production is destroyed, they will question and reevaluate their relationship with the United States. The hundreds of billions, if not trillions, of investment from the Gulf states that is in the US debt markets and stock market can be liquidated and pulled. Not immediately, not overnight, no, not even close. It can happen. It is a slow, progressive thing that would occur. And we would see that with immense sell pressure, a controlled sell that has strong sell days, followed by a bounce or two, followed by more sell pressure. That's the black swan. That is the major potential. People talking about an AI bubble burst. The AI bubble would only burst if it follows the same trajectory of every other bubble. Every other bubble is due to overexpansion that is not justified by the economics, but by the mass psychosis of we need to just keep building. We need to just have railroads to forever. That's where the first industrial revolution bubble burst, with the railroad companies going bust, because you're building railroads to nowhere, excessive and excessive. The AI companies have excessive investment and so forth, but we're still at the early stages. The bubble would not be bursting, or nowhere near bursting, in my unprofessional opinion. So I'm much more concerned about the Gulf states withdrawing their investments from the United States financial system, the debt market, the stock market. I'd be much more concerned about that and the trillions of dollars that the Saudis control, along with Bahrain and the Kuwait and the UAE. These Gulf states control immense amounts of money. And if they are reconsidering reevaluating their relationship with the United States, it has first, second, third, fourth degree effects. This isn't, an AI bubble. This is the people that have invested may want to pull their investments because they're not happy. So, sorry to get off on a political tangent, but the politics are creeping into the financial markets more and more. So, the Bitcoin analysis is still, it depends how you view Bitcoin based on the Thinkorswim platform here. The Thinkorswim platform is showing the first trading day as the 2nd of January, not the 1st of January. So based on that close, like the close of 88,120, that's close enough. Year to date, Bitcoin is down 17%. It's not in a bear market. Bitcoin beneath 70,500, 70,400. Beneath this area is where Bitcoin is in a bear market. In the short term, I am willing to shift my thesis on Bitcoin from bearish in the short term to neutral, bullish neutral, because you have been consolidating here. You have the low on this trading day. One trading day later, you can just see that you've been consolidating. This is the 26th bar, 26 days of Bitcoin holding higher lows versus the low, higher lows. You have a high here. You really need to be above 75,000 for the buyers to start to gain control. Let's not forget there is a unfilled gap between $84,560 and $77,730 per Bitcoin. this unfilled gap here on Bitcoin. So there could be some upside pressure pushing Bitcoin higher. The structure of holding higher lows and trying to test higher highs is definitely indicative that the buyers are gaining more short-term control than the sellers. The long top wick has a signal that sellers are still in this market. In the second half of the day, late day, they're willing to overcome the buyers and push price lower. Whether or not they continue to be present, I would be interested to see where the gamma levels are, where institutions have a lot of orders to buy and sell Bitcoin, and where Bitcoin might be gravitating towards. I don't really have those tools to analyze Bitcoin to that degree. My analysis is shifting the short-term thesis to neutral. Above 74,000, 75,000, I shift to a short-term bullish stance. I think it would make sense above 75,000 to then test 79,000. And if you can reclaim 79,000, then you're going to start working into this gap to be filled. And if the gap can be filled immediately, you might start to then see the buyers squeezing the sellers out of their positions. The sellers anticipate prices going lower, you sell low, buy it back high, but if price keeps pushing higher and higher, eventually you get liquidated. You have to buy back the Bitcoin you had shorted. And often this would be done via derivatives and so forth. So if you do get this gap filled in 1 or 2 trading days, you may get a very explosive move on Bitcoin that has continuation between the $83,000 to the $90,000 range. But what's most important is how the remainder of March trades. If the remainder of March can consolidate above 75,000, it increases the odds and the potential of holding above 79,000, breaking and holding this unfilled gap, holding above 84,000, and having the progressive continuation that the buyers would need for Bitcoin to retest its yearly highs and eventually go for its all-time highs. So again, this was discussed a while ago on the channel, that the different scenarios for Bitcoin, the worst case was that the sellers just continue to break through. And you can actually see on Bitcoin that 200 simple moving average is right there on the weekly. So you're still above the 200 weekly simple moving average, not the daily, the weekly. And the weekly chart, when we take the 2019 lows, 3,120, all the way to the all-time high of $127,240 per Bitcoin, you can see the consolidation has been occurring. Again, the higher low structure, higher lows trying to break to higher highs. More importantly, it's occurring above 65,180. That's the 50% retracement. That's the midpoint. And buyers defending this signals buyers are taking control in the short term. They need to clear the gap from the close of January to the start of February of this year. You got to fill that gap and have continuation higher. So there's real important times, the remainder of this month, how Q2 trades for Bitcoin. Will it be stuck in a consolidation area? When we look to the left here, you held above the 50%. Last time, there's been price action stuck in this area in the past, before we had made the all-time high, of course. I'm just wondering if we can test and reject the 79,000, 80,000 area, or if we will be breaking and having strong continuation above it. You let me know in the comment section down below how you believe Bitcoin will be trading into the rest of this year. I am very curious what the consensus of the comment section is. I really do appreciate comments, and I think I got one comment on a video last week that was someone saying BS, and I thought that was extremely funny that they were saying that my video is BS. It's any engagement is better than no engagement. So I really do appreciate likes, comments, subscriptions, all that stuff helps with the algorithm, and it gives me more motivation to make more content. I do have a job, and this is, more of a part-time thing, so I'll never have daily content, but getting the long-form content chopped down into shorts, getting that stuff uploaded at least weekly is something that I will promise to you, to the subscriber. If you enjoy this kind of content, please remember to like, comment, subscribe, and leave a comment down below. Are there certain tickers, certain stocks that you are interested in reviewing? The Beta Heuristics channel has talked about MARA a lot, and as the shift on Bitcoin goes from bearish to neutral, bullish, I believe looking at MARA, long hedges, long exposure, long dated calls or shares, this is not financial advice. This is, hypothetically speaking, how I would approach trading this or investing in this. Just wanted to make sure my show trades were off. I have been in and out of MARA, and in the short term, you can see on the yearly here, you have been consolidating within this golden zone here. And if we can retest $9, I think that might be an area where holding a higher low structure I think holding the structure is a signal that Bitcoin, if it's able to trend higher, MARA will likely trend higher. It's not a one-to-one correlation, but it is a Bitcoin proxy. MARA is a company that mines Bitcoin, that holds Bitcoin on their balance sheet, and they are also breaking into the data storage. It's business to business. It's enterprise, where they provide data storage to other businesses, which could diversify the company outside of just being a Bitcoin proxy. So there are different headwinds and risk that is unique to MARA that is not found in Bitcoin. Bitcoin has risks that MARA doesn't have. And to have exposure to the cryptocurrency markets without actually opening a cryptocurrency account, I can think of no other way besides investing in a Bitcoin or cryptocurrency ETF or trading a company like MARA or MSTR. Look at the weekly on MSTR very quickly. So MSTR really has long-term upside potential if, major if, Bitcoin has the mass adoption that Michael Saylor anticipates. Because I've done my best to explain Bitcoin as a form of currency is incomplete. It does not meet the three pillars of currency. For something to be currency, it needs to be a medium of exchange. It needs to have a unit of account and a store of value. Bitcoin is a better store of value than the dollar. The US dollar as a store of value is not good because there's an infinite supply of dollars. The government prints it, and there's a certain term where the monetary policy has been shifting. We don't need to get into those details. Bitcoin has a limited supply of 21 million. So a limited supply of Bitcoin compared to an unlimited supply of US dollars. The dollar is printed, and they use our taxpayer dollars to justify, how much more they can print and the budget deficit that they continue to grow. So when I look at Bitcoin, it meets a store of value standard. It has a limited supply, 21 million store of value. Hypothetically speaking, if you could crack Bitcoin, make synthetic Bitcoins, then that would invalidate the entire claim of 21 million, but I don't know of anyone that has cracked the Bitcoin blockchain. So that is store of value. unit of account and medium of exchange are the other two pillars of currency that Bitcoin fails. Bitcoin is not a good medium of exchange. To transact in Bitcoin, it requires a large fee. To send Bitcoin costs a large amount of money. You could say a wire transfer costs $25. How much does it cost to send Bitcoin? It depends on the gas fees, but I would say it's typically a couple $100 to send the Bitcoin. Average cost to send the Bitcoin. Am I completely wrong and the charts are showing it's now at historical lows of 34 cents per Bitcoin, the average transaction fee? Really? I guess I'm learning in real time, folks. Wow. Really? That is way lower. Why did I think? It's only 1 to 2%. Okay. Interesting. Okay, well, I am willing to admit if the data online is showing me the opposite of what I thought, I definitely was wrong. So you have a store of value. You have a medium of exchange. Maybe it's not a private medium of exchange. You could argue that if I know your Bitcoin wallet's address, then I can track you and how you're spending your Bitcoin in a way that normally I can't track you because it's such a public blockchain. Maybe that you can argue against, but it does have, with lower gas fees now, I would say its medium of exchange is improved. I can't explain why I thought the cost to send Bitcoin were higher, unless it's been reduced over the last decade or so. I really thought that it cost hundreds, if not $1,000 to send a Bitcoin. So I'll claim to admit my own ignorance there. So unit of account and medium of exchange, the unit of account is the one that I struggle to explain with Bitcoin. Because the US dollar has a very clear unit of account system. $1 bill versus a $100 bill, there's a clear difference. They're printed on the same paper, almost the same ink, slightly different pattern. The double zero on the 100 has a psychological difference that we associate with a larger value than a single dollar bill. That unit of account, very, very obvious. Bitcoin's unit of account, a Bitcoin is only worth what someone is willing to buy and sell it for. So the unit of account with Bitcoin is something that is a pillar to currency that I don't know how to rectify. I don't know how to signal or I don't know how to determine if Bitcoin achieves and checks off all three pillars if the unit of account for Bitcoin is simply the price of it is what its fair market value is. Because the unit of account with the US dollar is there's a gradient with it. You have a $1 bill, $5, $10, 20, 50, $100 bills. But with Bitcoin, it's just one Bitcoin's value is what someone's willing to buy and sell it at any given moment. So I would say that its unit of account is much more driven by speculation, while the US dollar's unit of account is driven much more by a robust financial system that has been tried and tested since the Bretton Woods Agreement. We've had the current monetary system, the current debt-based monetary system. So go look at a graph at what's changed since the 1970s. It's pretty nauseating. But Bitcoin here, having seen now that the cost to send Bitcoin is considerably less, I still can't get over that. Yeah, they've spiked over $50. $50 is still not a lot for a transaction fee. I was thinking it was a lot more than that. So if you have the medium of exchange due to low cost to send Bitcoin, you have the store of value because it has a limited supply of 21 million. You are not failing, but the unit of account is more driven by speculation than a clearly defined system of, one Bitcoin is worth, one specific value, just as like a US dollar. A dollar is worth $1. What that dollar can buy you changes over time due to purchasing power, parity changing, inflation eroding the dollar's purchasing power. So a $100 bill, what that buys you, a basket of goods at the grocery store today, is very different than 100 years ago. And that's due to the declining purchasing power. So I think Bitcoin in the long term is something that most people should be willing to commit anywhere between 1% to 5% of their portfolio. I am not a registered financial advisor. This is not my financial advice. This is an opinion I have that is an opinion shared by some other individuals that have commented online about portfolio diversification and, do you want to have a percent of your portfolio in Bitcoin? And if so, what percent? And it would never be a massive percent because something that is, its price is driven inherently by speculation. There is no true value on blockchain, Bitcoin. The blockchain itself isn't inherently valuable. It has utility. You have to build the usefulness off of its utility. Utility in itself isn't sufficient if no one's using it. It needs to have a use case. It needs to have justification. Bitcoin and cryptocurrencies are the perfect forms of currency for an AI or an AI agent, because an AI agent can't go to the local bank. It doesn't have an ID. It doesn't have a social security number. It doesn't have any of the information required to open a bank account and get a checking account. But AI agents, they can open cryptocurrency accounts and they can fund those if you give them the capital, and they can run wild with cryptocurrencies in a way that is not possible for them in the modern monetary system. Modern monetary theory is what we're currently experiencing. It was something that I read about when I was on Wall Street in 2019, and it was basically talked down upon by the Bloomberg article writer, because the idea of modern monetary theory is that the government can print money and print money and print money because they control tax rates and they can increase taxes and they can control the supply of money, the tax rates and so forth. But what this is failing to take account is the fact that you're just going to continue to print the dollar and the dollar will lose its value. And this has been very good since 2019 for risk on assets. Again, 2019 to now, Bitcoin has exploded higher. Most risk on assets are exponentially higher today compared to their 2019 prices. And this is predominantly because our monetary system has shifted more and more towards unrestrained modern monetary theory. Just printing money, having large deficits because the money's going towards the military-industrial complex. And there's, tangible physical goods, a Tomahawk missile, an Apache helicopter, a B-2 bomber, whatever the, weaponry is. It's a tangible physical good that is resulting from the money, but, it's not our money being spent on roads. It's the U.S. taxpayers funding the military-industrial complex, and it's foreign affairs, foreign policy interventionism. It's not taxpayer dollars going to fund the roads, the bridges, potholes, fixes, education system, etc. So when you understand modern monetary theory and how the government doesn't really care about the citizens, regardless of what political aisle you're on, neither side gives a flying fuck about the American public. So it's your responsibility to know these individuals are demons from hell and they will ruin this country, and I have to be responsible with my investments. I need to have my money invested in a way where, assuming they will destroy the dollar in a controlled demolition, you just continue to print it and print it. Eventually, the US dollar, a single dollar is buying a fraction of what it used to. At some point, you then replace the modern monetary system that we have with, they want central bank digital currencies, which is programmable money, which is just taking the Chinese model and copy pasting it, making it more Americanized. But it's a totalitarian, dystopian nightmare, which if central bank digital currencies are ushered in, I would hope there are mass protests, but we'll see. Bitcoin is a natural hedge against inflation because the dollar is printed and printed indefinitely, and a way to hedge against that is to have money invested in risk-on assets that are denominated in dollars. As the dollar loses and loses its value, things denominated in dollars, whether it's groceries, whether it's a Bitcoin, anything in between, these things that are denominated in dollars will increase in price because the dollar loses value. It's a very simple, very, very basic cause and effect relationship. And there's other macro levers, where interest rates are, etc. There are other implications for the financial system. The 10-year yield is starting to rise back above 4.2. It's trying to test the 4.3% area. I don't love rising yields. Rising yields are not a good thing. I've talked about this previously as well. The Japanese, okay, why is it the U.S.? I already did JPY. There. So the Japanese 10-year yield is at places that are pretty historic. So seeing the Japanese 10-year yield continue to rally after it's been historically pinned, real interest rates were negative in Japan when you account for inflation, real rates were negative. Now they're letting their interest rates rise. When people borrowed cheap yen at the low interest rates, they are now forced to pay back the money they borrowed at higher borrowing costs because the yen has been rallying. The 10-year yield for the Japanese bond market has been rallying. So how do you borrow cheap yen, you invest in risk on assets like Bitcoin, and then when the borrowing costs continue to rise and rise, how do you cover for those rising costs? You sell the risk on asset, whether it's Japanese stocks, Japanese bonds, or if you were investing in Bitcoin or other cryptocurrencies, that risk on asset is sold to free up the capital to cover the increased borrowing cost on the yen. This is the yen carry trade that collapsed that I've talked about in past recordings as well. So if the 10-year yield is rising in Japan and in the US, that makes me hesitant to be a bull in the stock market. It makes me curious how the cryptocurrency markets will be impacted by rising rates. If that will be a headwind or a tailwind to the cryptocurrency markets. I would think that when rates rise, credit is contracting. Borrowing costs are going up, so people will borrow less money. There's less money to be invested in the financial system then. So overall, risk on assets should come down. That is an oversimplification. There could be factors behind the scenes, macro levers that are impacting the cryptocurrency markets, Bitcoin specifically, and pushing it higher despite interest rates rising. Anything can happen. I just wanted to get this this stream out here to talk about Bitcoin, how year to date it has started to, it's been maintaining the higher low structure that it's needed to break higher, but now being above 70,000 again, above 71,000, this is where I'm not going to be bullheaded. I've been bearish on Bitcoin. I've been communicating the bear thesis, and it had a nice decline. I don't need to be 100% resolute in the short-term bear thesis. Long-term thesis is still bull. It is still up for Bitcoin based on the limited supply. 10 years from now, I imagine Bitcoin will be at a higher price than it is today. I could be wrong. Maybe Bitcoin goes to zero. Anything can happen. So I wouldn't risk more money than I'm willing to lose in Bitcoin personally, but I'm not a financial advisor. I'm not registered to give financial advice. None of this is financial advice. This is purely educational purposes only. And I hope you've enjoyed the material. Bitcoin, I'm shifting thesis more towards neutral, between 70, 75,000 neutral, below 70,000 bearish, above 75,000 short-term bullish again. Above 75,000, 79,000 is what I would anticipate is tested. Above 79,000, I believe the gap will be filled. Should be an interesting rest of 2026. I'm fairly certain there's no comments in the live stream. So unless someone has a question from the live stream to ask, I don't really know what I'm going to address. Bitcoin is short-term bouncing. It's not in a bear market. It depends how you viewed it. The way I was viewing it, again, first trading day on the Thinkorswim platform here. First trading day is the 2nd of January 2025. That is different than the 1st of January. So if you're using the yearly close price, Bitcoin needs to be really, let me see here, just basically from there, you need to be beneath 70,000, beneath 70K, you're down 20% on the year with Bitcoin, and at that point, you're bear market territory. Above 70,000, you're out of the bear market and you are consolidating higher lows versus the recent low. So Bitcoin is starting to signal that the buyers are attempting to gain control. But the current hurdle is this most recent highs. The high here being 74,210, the high here being 74,365. You need to hold an open and close above that for a number of trading days, not just one trading day. One trading day could be a fake out higher that then is broken back lower the next day. So you would need continued consolidation above the 75,000 area to then get the breaks to 79,000, breaking to fill the gap, etc. No comments from chat. I appreciate all the live viewers. If you would please like, comment, and subscribe. I know this format looks weird with how it is tiny, but this is all going to be chopped up, short form content on YouTube Shorts, on Instagram, at Beta Heuristics. I will try to get it on Substack as well, but Substack doesn't love short form content as much as YouTube and Instagram do. So you can follow there. The Substack is more for the long form content. This is where a QQQ market look ahead report will be. This is where you can find the seasonality analysis back here covering the 4 major US stock market indices ETFs based on their daily range percent. And this data has already been reviewed a few different times on videos. It's still available. No subscription needed. You can subscribe to Beta Heuristics for free on Substack. Free to subscribe. Substack, YouTube, Instagram, X, all the social medias. Until the next recording.